The CPI inflation report for August was a major shock to the markets, as inflation accelerated from a month before, even with energy prices falling significantly from the prior month. This led to a massive crash in the stock market indices, as investors were caught completely off guard by the rising inflation. You see, for weeks, analysts and news commentators have been talking about peak inflation having already occurred, and the running theory was that stocks could rally as inflation data showed those declines in inflation. The idea is that a decline in inflation means that the Federal Reserve can slow down or stop its interest rate hikes, which would be good for stocks. The truth, though, is that everyone who has tried to call the top on peak inflation so far has been wrong. The causes of inflation are still very present and are unlikely to clear up in the near term, which we'll cover shortly. But if you want a good laugh at how wrong some of these analysts were, take a look at some of these ridiculous headlines that were published right before the CPI report had higher inflation than everyone expected. My personal favorite is this article about how a, quote, inflation collapse will launch powerful market rally Credit Suisse predicts. That was published literally the day before the CPI print caused the NASDAQ to crash down over 5% in just a single day. They might have jumped the gun on that call just a little bit. These headlines and narratives worked, though. Investors started to believe the hype and idea that inflation might be peaking, which led people to buy stocks before the CPI report, with speculation that a low inflation report would be a big catalyst for a stock rally. The 4 trading days before the CPI report, investors piled into the NASDAQ and pushed the index up over 6% in hopes of a good inflation report and more gains. Instead, they got rug pulled because the narrative that inflation has already peaked was not reflected in the actual CPI data at all. If we look at the actual CPI data for August, headline inflation was up 8.3% from a year ago, and it increased by 0.1% from a month ago, which was when people really first started to believe that inflation might be peaking. The alarming thing about this report is that there was an inflation increase by 0.1% from a month ago, even though energy prices declined by 5% from the prior month. The only other category that declined besides energy were used car prices, which declined by 0.1% from the prior month. On the other hand, notable increases were in food prices, which were up by 0.8% from the prior month, and shelter, which was up 0.7% from the prior month. Every other category had increases as well, except for the aforementioned energy and car prices. So commentators and the people that believed them about inflation peaking were caught pretty off guard by this surprise increase. The narrative that inflation is peaking has been looking past the fact that the supply chain issues that have been fueling inflation have not been resolved at all yet, and may not be fixed in the near term either. The global supply chain is in disarray due to geopolitical issues and other factors that have created widespread shortages. China's zero COVID policy, for example, has led to lockdowns in major cities in the country, which has caused manufacturing for parts and goods from China to slow down significantly. There are many companies that rely on China for their manufacturing, and this has presented severe limitations to their manufacturing capabilities because entire cities have been locked down in China due to the government's response. These shortages decrease the supply of manufactured parts and goods for these companies, which drives prices higher for the products to offset the lower supply. The Russian invasion of Ukraine has also caused massive problems for the supply chain, as Russia is a major exporter of oil and natural gas, which has contributed to the energy inflation we've seen this year. Russia is one of the world's top 3 crude oil producers, and in 2021, it exported an estimated 4.7 million barrels per day of crude oil to other countries. After Russia's invasion of Ukraine, Western countries issued sanctions on Russia. However, the reality is that Western countries can't completely stop importing energy from Russia, as many countries rely on them heavily for energy imports. This is particularly true for European countries that rely on Russia heavily for their energy. According to the International Energy Agency, quote, in 2021, the European Union imported 155 billion cubic meters of natural gas from Russia, accounting for around 45% of EU gas imports and close to 40% of its total gas consumption. End quote. Russia has been using this energy dependence as leverage against Western sanctions. Russia just recently halted all natural gas flows from the Nord Stream pipeline indefinitely, which is one of the main pipelines used to supply Europe with natural gas. This indefinite halt drove European natural gas prices up 30% in a day and left prices up about 400% from just a year ago. Because of the lower supply coming from Russia, the energy market is very tight now, which has been keeping energy prices high, especially in Europe, and is a contributor to global inflation. These supply chain issues are sticky problems that seem unlikely to go away in the near term, which means the driving forces for inflation have not been clearing. The speculators that are calling for an inflation peak in the near term should be cautious as long as these supply chain problems are present. A big part of the hope for the bullish thesis that softer inflation would be good for the stock markets is that lower inflation could theoretically mean that the Federal Reserve could pivot and lower rates once inflation has sufficiently cooled. However, this completely ignores the guidance and message that the Federal Reserve has been communicating to the market and investors for months. At the Jackson Hole annual Fed conference, Jerome Powell said, quote, restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. End quote. At the same conference, Jerome Powell also cautioned that, quote, restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. End quote. Based off of all of this commentary from the Federal Reserve, it's clear that they have no intention of lowering interest rates anytime soon, because the historical precedent shows that loosening monetary policy too quickly will lead to inflation coming right back. This is the mistake that the Federal Reserve made back in the 70s and led to a decade of high inflation, and they don't intend to make that mistake again. The idea that the Fed will pivot because of a few lower inflation reports goes directly against what they've been signaling, so investors should be really careful about buying stocks with the hope that the Fed is going to change its course soon. They've been pretty clear that they don't intend to. For all of these reasons, investors should be very careful with the idea that inflation is peaking. The supply chain issues that have been driving inflation are still in place, and if more geopolitical turmoil happens, they could even get worse. For these reasons, it's better to invest with a defined long-term strategy instead of speculating that there will be any near-term peak in inflation or a change in the Fed's policy to boost stocks. But be sure to let me know your thoughts about inflation and the August CPI report in the comments below, and leave a like on the video and subscribe to the channel for more investing and finance content. Thanks.